Okay, good morning everyone, and welcome to the penultimate session. I think that what I'd like to do is firstly just introduce my colleagues up here before we sort of kick into a fairly interesting debate on what is driving behaviour around pricing and levels in the market today. I think the last debate was quite fascinating because I think 5 years ago all we had to worry about was whether it was cash or non-cash. But today there's clearly many moving parts just in the collateral space, and I think what we'll learn over the next sort of 25 minutes or so is that complexity is a byword for much of what we do. In terms of looking at the issues, I'm delighted to be joined by a panel that you all probably know very well indeed. So just to my left is James Slater, Executive Vice President and Global Head of Securities Financing at Burney Mellon. Then Paul Wilson, who's Global Head of Agent Lending Products and Portfolio Advisory at JP Morgan. Then we've got Ben Chalice, Managing Director, Global Head of Equity Finance at Nomura. And finally, Tejas Patel, Managing Director and Co-Head of US Securities Lending at Morgan Stanley. I think just to sort of frame the debate and get your thoughts and reactions to some of the things we want to talk about, we've just got a small number of e-voting questions. So if I could just have the first e-voting question up, please. Just like you to think about to what extent is the impact of regulation, particularly around capital and risk-weighted rules, now being felt at a desk trade level? Is that sort of high, some impact, or no impact at all? It'd be good to get your reaction to that first one, please. Okay, that's sort of pretty much as we would expect based upon the discussions we've seen over the last couple of days. The final thing before we move on to the next question is the next question, please, which is that to a greater extent more than this time last year? Okay. I think that's pretty clear. I think one of the key things that I took away from yesterday's discussions was very much around the fact that we didn't have a particularly regulatory-driven session. There was not a single session that said the dreaded regulatory update or whatever. But every single session talked in great detail about the impact of regulation and what that means in today's markets. I think regulation is a factor that we have to live with. But in terms of looking at our businesses, I'd just like to move on to two further questions. Have the next question up, please. Okay, so when looking at your businesses today, perhaps you give me a sense as to what is the single biggest limiter or constraint on your business today? Is it reg capital? Is it liquidity? Is it balance sheet? Or is it perhaps CCAR or the equivalent stress test regime here in Europe? Okay, 43. Okay. So I think we can see here that it's a fairly sort of broad spectrum, but clearly people aren't that worried about stress tests and whether or not institutions pass muster when looked at by regulators. But clearly there's a fairly even spread between reg capital, liquidity and balance sheet. And I think that does reflect the nature of where we are today. And before I open up the debate to the guys here, one final question please on if you looked at, when you think about your business, what is the primary driver of the elements you look at when thinking about pricing, demand and supply in your market? Is it counterparty credit? Is it jurisdiction of the lender? Do we worry more today than we did before about the domicile of a lender? That inevitably brings us to the next point, which is netting, which I know we're going to talk about shortly. Is it term structure? Is it collateral? Or is it all of the above? Okay, that's interesting. So, gentlemen, I mean, I think we've got a very clear steer as to what people are worried about, what drives behaviour, but, I mean, it might be worth just getting your initial thoughts on whether you think that's a fair representation of what you see. James, would you like to kick us off?
Sure. I think certainly for all the organizations that are here, banks and dealers, your treasurers or CFOs would be happy to see the results from this from the survey, because it basically tells us that people are starting to pay attention to balance sheet and capital and the regulations and trying to understand them. I know one of the focuses of this panel is really to talk about what's driving pricing in the market, and I think that that's a good topic right now. It's very topical. One interesting observation, though, is before we get into the dynamics of pricing, is really how prepared are we and how prepared are desks to understand the implications from all the regulatory change. And from my vantage point, I think there's still some room for the market to become more efficient. When I look across, the different desks that the street would have, the equity finance desk, the fixed income desk that might be doing upgrade trades, and then the reinvestment desks and the money space. There's situations where equities are getting financed across multiple desks within the same organizations, but under relatively similar terms with similar counterparties, yet being priced very differently. And I think that gap has been closing in, which is a sign of efficiency and understanding. But I'd be interested in thoughts from my fellow panelists as to the relative level of preparedness and whether people really understand. I mean, I think a couple of those questions were, is it the change year over year? And it is pretty dramatic. I think people are feeling that. My sense is that the full impact of the regulatory change and the many forces in play hasn't really been fully translated into how we price.
Okay.
Yeah, I mean, I think at the moment it's kind of feels like the train has left the station. We know where the train's going to end up, but everybody's on different parts of the journey, I think is the way I'll describe it. And I think that right now, whether you're a borrower, and Tejas and other colleagues can talk about that, but it's really, really unclear. Every firm is very, very different in terms of desks, right? Banks are generally dysfunctional organisations, okay? Although there's a lot of work going on in banks to bring financing-like functions together. My job as an agent on behalf of my clients is to pick off those inefficiencies and make money from it. Particularly also when you think about the lender side of the business, okay, indemnification has basically been the free lunch that most of the beneficial owners have had. And right now the playing field is probably more uneven than it's ever been, because people have been dealing with capital in a very, very different way historically. Some are probably putting off the inevitable. Some are probably not being allocated capital at this moment in time. So you are seeing huge distortions in the way people value business. And the end point is really clear. I mean, everybody is going to be working to the same set of rules. So you do have a bunch of anomalies in the market right now in every single area that makes the market very, very inefficient. And that is also driving some, differing behaviours from different organisations.
Okay.
Go on, Ben.
Ben, hi Ben. Yeah. Very good.
No, I think you're absolutely right. The result of the e-voting questions demonstrates that it's far from a level playing field. People are at different stages of the interpretation of regulation and certainly the implementation of regulation. And the fact that we had such a disparate answer with regard what was the primary driver was really evidence of that. And so, because different people are limited by different factors, that's going to influence, I'm sure, what we're about to debate in terms of the primary elements that defines price.
And I think we're still in the process of price discovery for a lot of what we're doing within our businesses, right? And to Ben's point, the factors are very different depending on how much is actually, what part of that train track you're actually on at each institution. And I think, at some institutions, it's more important to think about the entire business of financing and look at that as one portfolio and think about what the return or the benefit of that entire portfolio is. At some institutions, because of how they're actually organized and how they're set up, it's specifically going to be thought of trade by trade. And I think that's where we get these misconnections, right? And these inefficiencies, because if the trade still prints then that's a market transaction. That's in the market. It actually occurred, right? When you step back and think about it from a portfolio perspective, if that's the only focus that you have is the overall portfolio, I think you're less worried about each individual transaction. You're just primarily concerned about what's happening to the overall portfolio.
I mean, one of my thoughts around what you've just said is that clearly there's some anomalies out there that we see within firms or across firms, but isn't that a classic opportunity for traders? So clearly, if we want to remove all anomalies and get everything the same, will we make less money? I mean, is this an opportunity to make money or a limiter of what we can actually do? It seems to me that if you've got an opportunity to arbitrage between one desk and another, you would take it, wouldn't you? Not necessarily internally, because that's never good fun, but across organisations.
Yeah, I mean, look, for the industry right now, the supply side is not the challenge, right? And I think I've said it before. If you look at over the next 2, 3, 4 years, the amount of borrowing that's going to go on, okay, which is what drives our business and the motive for us to do business for our clients, is unlikely, absent any kind of event that we can't foresee, and absent a sizable change in rates, going to change, okay? And so from our perspective, it's not about just selling it low and stacking it high in terms of having the most available inventory, because all we're going to do is just distribute the same value across more clients. It just makes absolutely no sense. So we've all got to be realistic about the challenges, right? Because the capital rules are kind of done. All right, and they're not going to get any easier. So you've kind of got to have a viewpoint on where the market's going to be, what part of the market you think you can take, and there'll be a few short-term opportunities here because of some anomalies, but I don't see them as long-term. All right, and overall in this space, and this is going to be the challenge for many of the beneficial owners, sort of the amount of revenue that's available is not materially going to change in the near future, right? And so it's about how we maximise that for our clients.
Well, I would say that I think at first you probably, and the industry probably needs to define what it is the motivating factor is, right, for doing the transactions. I think we've kind of graduated from being a pure capacity, pure size type business to probably being a little bit more concerned about all of those factors that were all of the above, right? And what that actually means in terms of yield, right? And I think we're still in this sort of maturation process in terms of what balance that's actually going to mean for each individual institution. The bottom line is there are still institutions out there that actually need the capacity and the size, right? Because of how they're made up and what their business model actually is. And then there are others that aren't. So I think, how we think about that from a trading desk perspective, right, from operating in the business and trying to still remain competitive on the other side of our business, right, where we actually distribute those assets, that actually plays a very, very big role in terms of how we operate.
Okay. Your point at the start, Andy, I think was well made in terms of an individual securities lending trader, or call them what you want, needs to understand all of the variables that go into pricing a trade nowadays. And I was surprised to see such a high percentage on that first question, that a lot of that funds transfer price, or the cost, the wholesale cost of funding being allocated down to an individual business level was as high as it was. And I certainly think that there will be different interpretations of that, back to the point I made earlier, which means that it's not a level playing field, and therefore those anomalies are going to exist for a long, long while.
I mean, the one thing I just thinking about is that when we talk about the increasing complexities around how the broker community might want to think about how they transact with the supply side, clearly the level of complexity, or complication rather than complexity, is going up, not down. And question for the guys here who actually marshal supply side assets: what does that mean for beneficial owners in the context of, are beneficial owners informed enough about these changes? Do they really care, about what it means in terms of getting their stock out the door? Because some of the dynamics around things like, jurisdiction and netting came up on that list as things that are important. We will talk about ALD in a minute, I'm sure, but the reality is, what does that mean to a beneficial owner looking at their program? What should they expect to see? Is it going to change materially? Because it's just going to look the same, but there's a lot going on behind the scenes? Or do beneficial owners have to really think materially that it's changing and they've got to make some decisions?
That's a big question. And it's a complex one, I think, and I think it depends on the beneficial owner. Certainly the larger, more complex funds, I think, are getting their heads around it more. I think the issue of jurisdiction is an important one that's becoming very topical in certain areas of the world. One of the drivers here too is collateral flexibility. So there's a lot of education. I think agent lenders have been working for many years on that, and that's become more important in today's environment, which really boils down to the risk appetite. So what's the risk appetite that beneficial owner has for the return that they're looking to achieve, and it's risk reward are equally offset and balanced. So but I think that's a lot of the discussion, debate, among beneficial owners in terms of their participation in lending.
I think it's all about perspective. You kind of got to understand in terms of what we do is really add a small amount of value to funds whose motive for being in existence is very, very different from gaining a basis point or two from sec lending. So you've just got to have a perspective, right? And one of the challenges is that we all face is that if it becomes too problematic or the overhead becomes too high, there isn't a beneficial owner in the world who just won't stop. I mean, we need to we understand that. And so perhaps one of the I don't know if it's a positive or a negative thing insofar as if you think about some of the new reporting that beneficial owners themselves are going to have to do. And yes, there's probably an expectation that a lot of the heavy lifting will be done by the agents. We wouldn't disagree with that. But there is a bunch of reporting that every beneficial owner is going to have to do themselves. There are going to be a whole host of those that say, that's just too much hassle, I'm just going to stop, all right? So again, taking that perspective, I think that the vast majority of beneficial owners are informed. I think they do get it, but you've got to understand what's really, really important to them in terms of what they're here for. Okay, and so they're not out there chasing every single basis point of return. Yeah, every single one of them probably leaves some money on the table, but it is not going to change their organisations. All right, so yeah, it's a tough discussion with many of them. I think many of them are very comfortable with what they do. All right, and making change, all right, given what the industry has lived through, is a very, very traumatic event for people. And by making a change, I mean broadening, doing more, being more flexible, taking different collateral types. It's very easy to say that. It's very hard. You need to understand where we've come and some of the negative publicity the entire industry has had, right? And people have got long memories. So I think they completely get it, but I think it's about perspective.
Okay. And guys, from a sort of a broker perspective, when you think about the complexities of pricing, I mean, is there we had that slide which sort of said all of the above is important. I mean, in reality, is there, what measure drives behaviour, and is it the same for both of you? And do you see it the same when you face off to different beneficial owner groups? I suspect it's not, but it's good to get a sense as to what your thought process is when you think about that. And because I think one of the challenges the beneficial owner community has is that they've got a lot of new things flying at them, as Paul said. There is a danger that they just go, well, this is just way, I'm not doing this, for an incremental, marginal business. And I'm just keen to get a sense from you guys as to what is it that you find is driving what's important to you now. And
Nomura's primary metric that we're measured on in terms of each business is a return on capital metric, which probably does differ from a lot of other entities. But in answer to your question, there are two dynamics. There's one, the individual trade level of the basis point fee that you're going to be borrowing on an individual security. But then there's the portfolio effect of the fact that we have to consider the overall margin slippage on the book, which constitutes towards liquidity capital. We have to think about the regulatory capital, which for our business is typically driven by counterparty credit risk. We look on the whole around our liquidity coverage ratio, hedges in the form of repo at risk. We've got to think about the committed facilities we may be offering clients. We've got to look at, in terms of internalization of netting. And that's a much more macro discussion that a beneficial owner is not even going to care about. I doubt that these guys even care about that kind of stuff, but it all constitutes and contributes to that return on capital metric that we're overall judged by.
So basically all of the above.
Yeah.
Right. That's the big difference. And you started off the panel saying, many years ago it was whether it was cash or non-cash, right? And now, and it's pretty inefficient in terms of how we actually get this information. But now you're literally looking at the overall portfolio, thinking about all of these factors and how you can potentially influence the overall portfolio to hopefully get yourself in a position where you're still competitive, again, on the other side of the equation. Because depending on how good of a job Ben has done or how good of a job someone else has done in terms of actually understanding all of these metrics, that's going to determine how you actually price the other side of your trade, right? And that hasn't actually fluctuated as much just yet. Will it?
You've got rigidity on your client side where you have to absorb, let's say, the shocks that might come through from your sort of supply side.
Yeah, or you're spending a lot more time and energy trying to make that process a little bit more efficient.
Okay. So
And just
but
let
yeah,
me just add, I agree, our business is judged pretty much on one thing, return on equity. It's a single number our management looks at, return on equity. Not really worried about revenues, not really worried about expenses, what's your return on capital and equity? Really, really simple. Yeah. But a lot of the trades that we're kind of talking about, we need to understand what they mean from a capital perspective. Capital efficient for these guys, great for our clients, more capital for me.
Right.
Right. I mean, that's what you're actually doing, because our clients expect to be indemnified. So they're expecting the JP Morgan balance sheet to sit between those transactions, so we're absorbing the risk. The risk doesn't go away, but they're getting efficiencies. We're taking the risk, okay? And we have to use capital on that. And so we will be, very, very egregious about who we trade with, the term of the trade, the fee on the trade, which clients, which jurisdictions, and all of those stuff at a trade client and desk level and counterpart level. And again, we're down to a point where if our management said we need you to reduce RWA by $1 billion tomorrow, I'd know exactly which trades to take off.
Okay.
No, down to the individual borrowers, individual trades, what would happen and what would have the minimum impact.
And James, is that the same for you guys? We heard yesterday a lot about forensic analysis of balance sheets from the very large sort of institutions in Europe. Is that, it sounds like you do that process as well, Paul, in terms of the way you and James the same?
Absolutely. It's borrower default indemnification attracts capital in the new regime, and it's changed materially. Under the old rules, the banks and institutions were allowed to use an advanced measurement approach, and it didn't attract a ton of capital. Under the new rules for U.S. banks, because of the Collins Amendment, we have a minimum of Basel I standards, which is a standard measurement approach. And that amount of capital that's getting set aside by agent banks for this activity has gone up multiple folds. It's not like 10% or a couple times. It's tens of times higher.
Okay.
So what you're saying really is then you never in the past had enough capital against the indemnification then?
No, absolutely not. No, I think the advanced measurement approaches that are being used, and you know this, we're looking at the economic risk, modeled, tested, battle tested. We've been through situations with Lehman and other defaults and seen the results of how those models performed and how those portfolios performed in a stress situation. But now we have a situation where the economic risk, if you will, that we see with these transactions and the regulatory capital that's being set aside, there's this huge chasm. So it'll be interesting to see how that kind of evolves over time and whether that ever gets revisited by the regulator. So okay. to your and Paul's point, we've gone through that analysis of looking at each of these transaction types and figuring out what the regulatory capital impact of that is. And we are making certain decisions and favoring certain types of activity over others in this new environment. And if our feet were ever held to the fire, CFO said you need to reduce RWA. Yeah, we have that number. We know those transactions.
Okay, so you've all got sensitivities around different forms of capital balance sheet measurement. Do you feel, and I guess we're going to have two views on this, is there more room for other products and other trading conduits, such as CCP or synthetics, in this marketplace to ease that charge at either end of the transaction? I mean, guys, what do you feel?
Undoubtedly.
Yeah.
Of course.
Undoubtedly.
So why aren't we seeing more of that then?
because the economics will ultimately drive it. Okay, and as I said, everybody is still on that journey. You kind of know where the end point's going to be, and you know whether it's a CCP, whether it's synthetic, whether it's other different trades, GC, term, who knows, right? But ultimately, the business will transact itself in the most capital efficient and operationally efficient manner, right, for everybody. I mean, I think that's just a given. How that transacts.
So the plain truth is that there isn't. You know, you say, well, why don't we use CCPs? Where the bulk of the activity in this space is on the U.S. market, there isn't a platform that allows for an agent or beneficial owners to efficiently enter the market.
Okay.
On the European side, I think there's some developments and things are progressing, and there is a model there that could be used, but it's not scalable. And there's a lot of questions around CCPs that still need to be answered. The last panel. The last couple panels brought up a couple very important issues around, on the risk side and understanding that, and there's still work to be done.
And Ted, in the synthetic space, I mean, you've done a lot of work in that area. I mean, do you see the synthetic supply route becoming a substantial part of your business going forward?
I'm not 100% sure it's actually scalable, right? And I think to Paul's point, right? I'm not 100% sure we know what the end point is. I'm not sure we know what the end game actually is. I actually think we're probably in a scenario where we're in the process of trying to test a few things out, right? The idea of a CCP, right? And in the States you have the OCC, which is completely broker-dealer, doesn't necessarily involve any client flows, right? The synthetic route, right? This has been going on for years. It's just potentially a little bit more prevalent now because primarily, almost all broker-dealers are in the process of figuring out what they're going to do with their balance sheets. And it's a accounting way to potentially get around that type of scenario, right? So it's an option. And I think at the moment, what we really need to be thinking about, in my opinion, is just trying to keep our options as open as we possibly can. Yeah. That's going to probably require many people to be a little bit more open-minded about things that probably seem a little bit uncomfortable. Maybe seem a little bit, potentially dangerous to what it actually does to the actual model on a moving forward basis. But I think if we keep those options open, the biggest thing that we preserve is capacity, right? And that's what we should really be focused on, because if you think about the demand side of the equation, you're looking at multi-year highs in terms of AUM. People are going to need to borrow stock, right? And it is the foundation of what we do, right, from a financial services perspective. So anything that we can do to potentially preserve capacity or actually preserve our ability to grow, I think we should potentially be considering.
I think we're being actually very naive to say that synthetics haven't been used for many, many years. Yeah. Derivatives desks trade amongst themselves. Synthetic transactions, whether it be TRS or any other product, to fund themselves outside of the secured funding business within banks. Yeah. I think what's happening now is banks are integrating those businesses a little bit better and allowing the secured funding business, which is typically the world that we revolve in, to transact those products holistically, rather than being disparate. And so, I'd agree with Tejas that it's limited by its scalability, given the amount of securities, especially in the equity space that we trade, and the fact that you're not going to be able to fund yourself if you're covering lots of high frequency transaction clients. But certainly the larger, more stable inventory on your platform arguably should be traded synthetically, because it is a lot more capital efficient.
Okay, and just on that point around how the market trades. In Europe, we talk endlessly about agent lender disclosure and the framework that supports a lot of our business. Are we really ready as an industry in Europe to move to the next level when we talk a lot? I certainly chair a lot of working groups around is ALD working yet? Is there a better structure out there? What would it look like? I mean, guys, is the ALD structure, I think someone mentioned it on a panel yesterday, the identification of the client you've done the business with on T+1, is that really sustainable in the medium term?
Not at all. I mean, you've heard me talk a lot about this, and I was fascinated to hear both these chaps say that they would know immediately what trades to take off if they were asked to reduce RWA, because I wouldn't, because I can't even identify the counterparty because it's transparent to me.
And we talked a lot about ALD, and is this just a function of the economics? Because this is a big decision around infrastructure and cost, or is it something that, why aren't we fixing it? I mean, that's my question.
There's a whole bunch of challenges which I don't think we know the answer to. So if I think about my client base, we have a lot of clients that participate in this market, but are concerned that when they lend their securities to Ben, that Nomura effectively knows what security they own, and it might be a security where they might be trading that to sell it or buy it through Nomura. So a lot of the ALD process has always been set up to protect the anonymity of clients from the trading desks, and that issue is going to become bigger as Ben has quite correctly said, businesses in banks are becoming closer and closer together. So inevitably there needs to be a better upfront ALD solution, but it's probably not Ben knowing who he's borrowed from. It's somebody in Ben's organisation knowing who they've borrowed from and should be able to get to it. And that creates an almost, not impossible challenge, but a really, really complex challenge, all right? Because that confidentiality thing is a real big thing. And it's not, by the way, that these clients have any concern about disclosure in itself as a point of principle. It's, I bought this security through Nomura. I've now lent it to them. They know what position I've got. If I trade out of this, how do I know that you're not sharing that information, right? So, one of the things I know you wanted to bring up corporate actions, and it's one of my favourite subjects. So I'll let you have your rant about profit shares. But the reason the profit shares are going the way they are is because, very, very well-paid investment bankers at Nomura and others are going directly to our clients and offering them 85% revenue shares to take us out of the equation. All right? So actually that information in some of the banks does escape, because I was on the call with a very, very large fund manager last week. We're asking him if he would commit to a particular trade. He went, funny that, I've just had one of your banking competitors and they're offering me 70% revenue share. So you kind of reap what you sow a little bit. So we have to be, and that's a really good example of how information in some of the borrower organisations isn't always ring-fenced and appropriate.
I would disagree that that's the primary driver of where that information stems from. There's plenty of information providers that show you who the beneficial owners of securities are, especially as the market's moving to increase transparency. That information is only going to be more readily available. Going back to the capital point before we address the corporate action point.
I know you wanted to talk about that.
No. You just cut me off before I could do it.
I could have achieved something today.
The main problem is where, as I said, for Nomura having a return on capital metric being the primary driver, we're a securities firm that's relatively thinly capitalized in the UK entity we do most of our business from. Yeah. You've got a business manager saying, I want to understand any transactions that will incur capital of X. We just can't do that, and to have that information stored by someone in credit or legal just doesn't work. Fundamentally, unfortunately. And to your point about why there's no solution, I don't know.
And I think, the ALD thing, I think, is not something that we've necessarily got the time to sort out today. But I think it's becoming increasingly important and clear to me that, we've got to address these issues because it relates directly to things like netting, jurisdictions and all that stuff. And I'm just conscious that Ed is lurking over there, which means that we're coming towards the end of our allotted time. So what I was going to ask you guys is, from the perspective of what our objective today was to talk a little bit about, the changing dynamics around pricing, what it means to the clients on both sides of the equation. Just by way of conclusion, could I just get a bit of a sense from all of you as to, what are the key takeaways from this session from your perspective in terms of what are the messages we need to either get out to our clients or to our prime brokerage clients on the other side, because clearly, at the end of the day, you're servicing their needs. We've forgotten them to a large extent in this debate, but they're also part of the value chain. I mean, Tedges, we may go to you first.
So fine. For us, I think it's a few things, right? One, we believe that this business is, the bedrock of everything that happens in financial markets, right? It is the starting point for many things, right? So in some way, shape, or form, we do need to figure out how to preserve it. right? And I say some way, shape, or form because I think we're actually in the process of figuring that out. It's going to become a little bit more mature, and it's going to look a little bit different than it did maybe 20 years ago. But it's still going to exist. It potentially exists in a different wrapper, and we just need to be in the process of figuring that out. The other thing is that the business is also quite elastic, right? You know, and I think with some of the things that are coming down the pike, you know, we're probably going to test that elasticity to a certain degree. You know, at the end of the day, you know, if we keep our minds open and our sort of our thoughts, you know, open to what potentially exists out there or what potentially still doesn't exist out there, we will navigate through it.
Okay. Paul, do you want to, Ben?
Yeah, no, I think, as we've said, it's all about evolution. We've talked about some of the kind of component parts to pricing, but we've not even started to discuss the fact that banks need to be a lot better connected with the different businesses to understand when they're dealing with a client, the financial resources that they consume, the effort that actually goes into servicing those clients, as well as the actual bottom line return. Okay. And I think that that's going to become ever more prevalent. But we're very much, to my mind, in a state at the moment of first mover disadvantage. Who's going to blink first? Because, you know, if you are pricing something correctly because you understand the trade better because of all those component costs, then you're not going to win that business. And that's the struggle that we're in right now.
Paul?
I think business is going to become more complex. I probably heard today that the playing field, because of capital rules, is going to be probably uneven, affect people in different ways. I think it's been like that since year dot, quite frankly. It's just going to affect different firms in different ways. And so, you know, there is a great deal of opportunity out there. I mean, I don't want to come across as perhaps as pessimistic as I might have sounded at the beginning, but I do think there is a great deal of opportunity, okay? And we need to kind of work through some of the current challenges, right? And at the end of that, there is a lot of opportunity. Because I agree entirely with what Ben and Tejas have said.
James?
I'm going to echo that. I think there's, you know, I see a lot of opportunity. There's been seems a lot more discussion about doing business, and I think this panel talking about pricing is about getting on with it. You know, the last year was all about sort of digesting the regulatory change, and I think that's, you know, it's at various stages of evolution in organizations, and I think most of us are getting on with it and talking about doing business, which is great for the future. And being open and staying flexible are, I think, a key theme out of this panel. And it also sounds like ISLA has a working group coming in its future, Andy, on ALD.
Yeah, and I think, you know, I guess we're coming towards the end of our time, but what I would say is, actually, I think the debate this morning is quite refreshing because we've got traditionally, you know, two sides of the market that perhaps in the past have not been prepared to share the level of detail and thoughts around how the business works, certainly in an open forum. So I think it's been a good, from my perspective, level of understanding today to understand what is driving behaviour, why things are important and not so important. Ed, I don't know where we are on time. I guess we don't have time for questions.
Yeah, we're going to have to wait on the questions, unfortunately. So do catch up with these guys afterwards and grill them on what price they're going to be supplying your stock at, I guess. Andy, thank you very much for that, and thank you to the panellists.